Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Before we get started today, I want to just very briefly ask everybody to check out the upcoming events, which you can find on the homepage of BMT, or you can find by clicking the webinars button at the top of the header. We have about 18 events scheduled in June for our very special 4-year anniversary. Every June, I try to put on a lot of very special events, and this time I think we have some of the best guest speakers that we've ever had on the site, including FT71 will be presenting in June, along with, I believe, 17 others. So check that out. We're going to be giving away many, many thousands of dollars of prizes, probably about $10,000 to $15,000 of prizes. The details are in a thread that's titled BMT 4-Year Anniversary. Okay, so today we have an Ask Me Anything session with FT71. This is probably the 6th AMA or so that he's done. We do it every 2 weeks. There will be another one on May 28th. And then because of all the events that we have in June, the regular full webinar that FT will be doing in June is going to take place, or going to replace the 2 AMAs in June, and then back in July we'll get on our normal schedule once again. AMAs are designed to be quick and casual. There's no prepared presentation, and they are limited to 30 minutes. You guys can go ahead and start typing your questions right now. We'll do our best to get all the questions answered. Once the session is over, I will post the recording in the thread. If you're not sure how to find the thread, on the top right of any BMT page in the search box, type in AMA space FT71, and that'll get you to it. Post number 2 in that thread has links to all the past AMA recordings. Okay, and with that, FT, I'm giving you control right now.
Can you hear me, Mike?
Yep, I can hear you now.
Okay, great. Hang on. Turn on the screen. Okay, being a registered broker, I have to start off with the risk disclosure. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Let's get to the questions. What do we have today?
There's several here already. Let me take a look here. Chuck is asking, when you take trades from the high and low volume node areas, what type of trade is it typically? Is it what you would consider top or bottom picking? Is it pullbacks in the direction of the trend? How would you describe that?
Okay, so I know I've said this word context quite a bit. If you've heard me before, I've talked about context. And really, that's that's the core determinant as to what, if the trade is from the inside out, meaning from a balance or a high volume node going out towards imbalance, or if it's from the outside in, meaning I'm basically fading a market that's balanced. Now, let's look at, for example, today. Today is not my kind of day. I recognize that it's not my kind of day. It was an open drive right from the get-go. It moved from yesterday's range out. I have not put on a single trade in the ES today because these are just not good days for me. And looking up at the risk screen here at my brokerage, it's not a good day for most people because most people are used to the market fading. And statistically, the market does not. Statistically, the market trends around 18% of the days sampled. It's a 1,500-day sample. So in those situations, excuse me, in those situations, I know it's a trending day, so I'm going to look for pullbacks to LVNs and trade in the direction of the trend. That's what I'm looking for. None of that has happened today. Even when I go to my trading time frame, which is the 2,500 volume, the market has not really pulled back enough for me to do anything with. We've had early on we had a 1.5 pullback, 1.5 pullback, 2.5 points. So you can see that the pullbacks are getting higher in magnitude. So this is the top is starting to show indications of weakness. Okay, so now I become interested, and what I'm looking for is a return to the IB, which is this line. But the IB on a trend day doesn't really mean that much. There is no initial balance. There's no balancing going on. The market's in a trend. So chances are it'll fall right through that, and then I'm looking for this LVN. So I'll start stalking the 40.75, for example, for a trade back up into 44.25. If I can get 2.5 points out of that trade, that's what I'm looking for. Overall, I try to look for 2 points per contract net. If I can do that on any given day multiple times a day, I'm in good shape. I don't try to catch bottoms or tops, or I don't boast about catching a 16-point move. I don't really care. I'm here to make money for the lowest risk possible. I'm not here to get a trophy. So to answer your question, it really depends on the type of day. If it's a balancing day, if you look at yesterday, yesterday was a balancing day. See how it's fat and it's concentrated towards the middle. I'm looking for pushes lower to buy, like down here to the mid. Beautiful test of the mid. I don't know if you guys can see that. I'll highlight it here. Just 1 second. So you see this? This is the mid right here. This blue line, push back to the mid, and I'm looking for those. I'm looking for it to make an excess high, and I'll look for a lower high, and I'll push for that back to wherever VPOC is. VPOC is the most traded price of the day. So because I recognize that this is a balancing day, it's not a trending day. Today I recognize it's a trending day, so I back off and I trade LVNs instead. Hope that answers your question.
Okay. Chris has 2 questions. He asks, can you explain a weak high, and can you talk about VPOC shifts and what it means?
Okay. All right. A lot of that stuff I kind of reserve for our traders as far as sharing that information, but let me cover it on a big picture level. A proper high made by the market is a high that is caused by the market pushing for prices, advertising prices so high that they become unsustainable or considered unfair. And when that happens, the opposing side, let's say for today, would be sellers coming in. The opposing side would see that there's a lot of excess, or there's a lot of value in selling that price up there. It's just too expensive. And so the high is made in such a way that as it goes up, as the market trades up, the volume tapers off very quickly, and the high peaks out and it falls quickly. So right now we have a medium strength high, but it is a trending day, and that, in my mind, supersedes how good a quality high we have. A weak high, however, and we've made a ton of these over the last few weeks because of this ever rallying market. A weak high looks like this. So a weak high is one where the market gets to a price and it just hangs out here. So if you look at that, the market did not it did not get done. Essentially what's happened that day is that it ran out of time. This is a weak high, and a weak high has an extremely high probability of being tested or taken out. And a weak high should not, the market should not linger at a high price. It shouldn't just sit there and kind of butt its head against it. And it creates, in volume, it creates this ledge, this shelf type of orientation, when the profile on a strong high would look like this. It would look like there's less and less interest in buying as prices go up. And it should be that way. If a bar of peanut butter is $3, and here it is at the market being sold for $6, you would notice that the shelf is quite full. There's no interest. People will find some other alternative. There's no interest in buying it. It's just too expensive. But if peanut butter prices go from $3, $3.50 to $4 to $4.50 to $5, $5.50 and $6, yet the shelf keeps staying empty, then there's an opportunity for whoever was thinking of selling to sell at higher prices, and therefore they'll keep offering that inventory at higher prices. That's a weak high. The opposite for a weak low. As far as VPOC shifts, again, this is an area where context is key. So if you look at the market, let's say the market traded a fair amount down here today and made a nice big fat volume distribution down here. And then it started to rally. Let's say a number came out at 9 a.m. Central or whatever, and it started to rally, and then it slowed down enough to now, for the most traded price, to shift from down here to up here. What this is saying to me is that sellers are becoming activated. Sellers are becoming activated enough to generate this kind of volume. In order for this volume to occur, there had to be an awful lot of buyers, and there are no buyers without sellers in futures. There's no, you can never say there are more buyers than sellers. They're always equal. Now, if there are so many buyers that the VPOC shifted to the top of the day, and then I see that price is, it's reloading, it's buying, it's buying, it's buying, it's buying, and then all of a sudden sellers are stepping in and it starts to move away, that VPOC shift closed off the buying. It ended the buying. There's an interested enough seller with enough size to cause the buying to come to an end. And generally what happens is it marks a top. However, if a VPOC shift occurs and there's buying and buying and selling, and then it starts to move up, what happens is that VPOC, what caused that VPOC, this point of control shift to occur, is an awful lot of late or weak sellers, and then what happens is generally that creates an additional pop, creates an additional wave of buying or short covering. And then, in general, that marks the end of the movement. So what you have here in today's situation is VPOC moved up here. There's an awful lot of volume up here. You can see the volume is quite a bit, 40,000, 31, 39, 36, 34,000, 31,000, and so forth, and it tapers off. A lot of these guys are locals representing short-term traders, and a lot of them are picking tops, and they will probably fuel another leg up before the market goes into a comatose, lunchtime trade. And that's the probability. That's what's most likely to happen. It could continue to go up. I don't know. But with a VPOC shift, it tells me there's enough there to either stop the move or fuel the next leg up. But the fact that the VPOC moved to the upper side of the day on a trend day tells me that this trend is becoming mature. If it isn't, there shouldn't have been enough sellers to create that shift in volume to this price, right? It shouldn't have happened because prices are still too cheap and it should continue to move up. But the fact that it did is a shot across the bow, as they say in sailor speak. It's a warning that if you are long from somewhere down here and you're holding on to your entire position, it's time for you to pay attention. And that's really the Reader's Digest version of what a VPOC shift means.
Okay. Mike has the question. He says, on Twitter today you posted that a 1.5 point counter rotation indicated a weak rotation and higher high was likely. What would have indicated a strong rotation with a lower chance of new highs instead?
So I believe that was back here. That was when we were down here. And this morning we made a 1.5 counter rotation. Then we made a 5-point rotation, a 1.5 counter rotation. If there was any weakness, we would have seen a bigger rotation than the last. We would have seen 2 points, 2.5 points, something like that. The issue with that, the reason I said look out for a new high, I think part of that tweet I said expecting more highs, because my target this morning was 40.25 and it hit it by a tick, 40.5, and it rotated down. And I said, okay, target taken. And then I said a weak counter rotation likely to take out highs is because it made a weak high at that point still. And the counter rotation was only a 1.5. I expect that if it hits my target, I expect this counter rotation to be 2.5, 3 points. There's plenty of fuel here for sellers to squeeze out the longs, and they didn't. So chances are it'll continue going, and that's what it did. And that's all that means.
Okay. Mr. E2 is asking, is there a difference between having a game plan and actually executing on that plan in real time? Oh, I'm sorry, he says there is a difference. How do you actually see most traders bridging that gap to turn a solid game plan into consistently profitable trading?
That's a very smart question. The issue with most traders and being part of a brokerage now and seeing how traders trade. Sorry, that's my risk alarm. Trend days, people fade the markets.
Yep.
So the biggest issue I see is not that people can come up with a game plan, because there's a lot of help out there. There's a lot of help on the Big Mike forum as far as coming up with a game plan. There are some really fantastic threads out there like Attitude Traders and others, where he's going over his game plan and so forth. The issue with most traders is execution, and the issue with execution is the fear or hesitation that comes with losing money. And so, to me, I think the biggest part of this is not really having a game plan, although many people don't. A lot of people don't. At least have a. If you don't have a setup, a trading plan that has certain setups or certain things you look for to measure the market and form a bias, at a minimum, as a trader, for you to survive, for your own good, at a minimum, you should have some sort of a risk plan, something that tells you when you are completely out of whack and need to stop. You have to have that as a minimum. And so, as far as Mr. E2's question, how do you see most traders bridge the gap and turn a solid game plan into consistently profitable? That's the holy grail. The key element is just self-awareness. I think is being very, very disciplined about journaling the outcome of your research and studying what you're doing in your trades, so that you can identify areas where you need improvement. For example, a lot of the traders in our brokerage, what I've pushed them to do is to keep track of what are called error trades. And one guy who trades the Dow a fair amount has found out over the last several months that approximately 56% of his trades are error trades. Over 200 points in the Dow are error trades. Just having that kind of knowledge helps you become more consistent in your trading, because it tells you you cannot afford to take a, hey, look, it's made new highs. Let me short one here. It looks like it's done. That's an error trade. It's outside of your plan, or if it's within your plan, you didn't execute it at the price you were supposed to execute it at, and you chased the market, or you missed the trade entirely. That's an error as well. If you can keep track of that and reduce your errors, the gains take care of themselves, and that's a big part of it. And that requires discipline. Meaning journaling, planning, doing homework, and just sitting on your hands. Look, today is not my kind of day. Not good with trend days. I just know this for a fact. And so if I know this for a fact, then I don't trade. I don't trade the ES. I look for other products, M6C. Just trade something else.
Okay. Sever is asking, do you have a set rule with market profile that you will take all the time? I think he's meaning, like, is there a particular setup that you're very mechanical about when it comes to, in your case, volume profile?
Okay. I don't, because the market profile and the volume profile are simply tools for me that give me context. And whether or not I take a trade, there are certain trades that I'll take under a certain environments. For example, I often take a mid trade. So this blue line, this dark blue line here, It's the middle of the day's range, the RTH, or the U.S. stock market range. And I'll take that, but I'll only take it on certain parameters. I will not take it on a day where the market is in an open auction or is in balance, where it's just going through that all the time. However, that's not a market profile setup, even though the mid shows up on a market profile chart. But I don't have, like, you know, I used to, for example, take the classic, you know, if we open out of range, if we open, for example, above the range, then I'll get long the value high from yesterday. If we open in a range, then I'll sell the value high from yesterday. I don't find an edge in that. It's much more important to me to understand what it's trying to do. Coming in today, I knew that we had a lot of balance. So I actually shared this image today here. These last 4 days have been very, very balanced. The market cannot tolerate this balance for very long. So I'm expecting I actually expected it tomorrow. I expected another day of balance today, and then a breakout of this range continuing with a trend tomorrow, but they decided that it's going to happen today. So I know the context is balance, and I'm aware that I should look out for a breakout type trade like we have today in the next day or two. Having that context, that alone helps me stay on the right side, in that I'm not fading this move, this big trend up like today. And that's, you know, if people could do that, I think that would save them a lot of heartache. So I don't have a consistent, I have certain setups that I'll take, but I'll only take them within the context in which they go with the context. So a single print, I'll take a single print long on a pullback if the context is trending up, things like that. And that's a market profile setup.
Okay. Nick is asking or commenting, he says sometimes he'll take a trade that's laid out and described in his game plan, but then the market will sometimes go well past his entry and stop him out before it, of course, turns around and it eventually plays out in the direction that he was originally intending. He wants to know how you handle that.
Okay, so that's very frustrating, and I feel your pain. The issue here is you're trading too tight. I don't know how big a stop. Can you tell us how big a stop you use? I don't know how big a stop you use, but chances are you're just way too tight for the market you're trading, and that's really why I've been advocating for trading the M6E or, you know, any of the micros.
He says he's using a 12-tick stop on the ES.
12-tick, that's pretty wide. That's pretty wide. It sounds like you need to work on your entry. Without knowing exactly what you're doing, it's hard for me to troubleshoot that. And also, without having like statistics over a set number of setups, like you would get with our trade analyzer, like how much heat, how much favorable, have you scaled on any of those trades, that sort of stuff. It's hard to really troubleshoot what the issue is. But if your stop is 3 points, which is a full rotation, that's a pretty good size stop for the ES. I'm assuming you're in the ES. And you're getting stopped out before you watch your trade happen, I would look at what are the reasons for your entry. It seems like you might be front-running your intended area. You know, if the trade ends up working out, the scenario ends up working out with a 12-tick stop, that surprises me. It seems like you're just reaching out too far for that trade. So I would look at your entry as a culprit. You know, what makes you enter? And if you trade multiple lots and you see that happen, one recommendation is to keep your stop at 12 ticks, 12 ticks from the average, but then average in. So if you're trading 2 contracts, take your trade where you normally take it, and then allow the market to go half a rotation or a point and a half against that before you put on your second one, and then use the new average as your stopping point. So it'll be 12 ticks from that new average. I hope that makes sense.
And Nick, what you might want to do is you could elaborate just a little bit more in the AMA thread on BMT, and FT takes a look at those every now and then and replies.
Yeah.
Okay, Scott is saying it's very standard that the initial balance is the first hour of trading on the RTH session. Have you looked at statistics that incorporated balance using an overnight trading time, since many days have economic reports pre-market and that can sometimes have a large effect on price before the open?
Okay, that's a good question. The reason it's 1 hour is it's because it's 4 pit periods, which are 15 minutes apiece. If you listen to Squawk, you'll hear this weird siren go off every 15 minutes. The reason it's an hour from 8:30 till 9:30 Central is because that's when the underlying is trading. It's a classic view, and I actually share that view. I don't really put too much weight on what happens in Globex. I don't really care if PPI came out and moved the market a certain amount. What ends up happening when you include the 7:30 till 8:30 session is you end up with these really wide initial balances that represent a period where the underlying stocks are not even trading. You know, the 500 stocks, for example, in the S&P are not even on yet. So the idea is for the IB is to measure what happens with the underlying basket of stocks trading. And that represents through arbitrage and everything else. It represents a truer picture of what supply and demand is within that first hour. And by the way, the initial balance is defined as the first hour because Pete Stadelmeyer made it so in the 80s. However, if you look at things like crude oil, gold, and other products, currency products and stuff, it's not an hour. You have to adjust. You have to adjust that. So you might want to look at not applying this 1 hour rule to everything, but the reason it's not 7:30 to 8:30 is because the underlying stocks are not there, and it's not a substantiated auction, so to speak.
Yeah, and whether you make it 1 hour or 90 minutes or 30 minutes, it's just providing context, right? People can't use. There's no such thing as all these hard set concrete. Okay, if this, then do this. Otherwise, do that. And a lot of people are looking for that, so you got to keep that in mind, guys.
Yes.
Sever is asking if you're strictly using. He says market profile, but we know that you're using market profile. I'm sorry, volume profile.
Sure.
Or do you use
both well.
Yeah, or do you use other things? He wants to know about Elliott waves, Fibonacci retracements, etc. So let me broaden that question. How much importance do you place on those? I know a lot of people, especially for Fibonacci's, put a lot of weight on the retracements, oftentimes on levels such as 50% or 100%, which aren't even Fibonacci numbers. But in general, when it comes to waves or Fibonacci, how important is that stuff to you?
Yeah, I mean, I've studied golden ratios. I've studied Elliott waves, wave sequence, impulsive versus corrective. I've gone through all of that. I've spent years sifting through that stuff. And to me, the bottom line is all of those are measures of price. And price is set by an opinion of those who are most powerful at the time or most aggressive, most motivated at the time, and that's why my focus is auctions. Now, with that being said, I will throw a fib up every once in a while if I feel like it coincides with an LVN or one of the levels that I'm interested in from volume profiling, just to see if there's any reinforcement in that area. But do I take every 38% pullback or 62% pullback or something like that? I don't. But I am well aware of, for example, impulsive versus corrective moves. That's something I started to discuss with our brokers. When you have a market that makes, where it normally makes somewhere between 2.5 and 3 points of rotation, suddenly makes a 5-point rotation, then I expect this to continue. And then when it continues, does it make a smaller rotation, and therefore should I expect a corrective move? That's Elliott wave. Or does it make a strong push, shallow pullback, another strong push, another shallow pullback where it's not corrective? This all becomes part of an impulsive move all the way up here. This is starting to look corrective to me. This looks exhausted to me. But then again, the context is we're going into lunch. So I use a combination of things. I'll use anything and everything that gives me an idea of what context I want to trade. That has to answer those the three key questions for me. What has it done? What is it trying to do? How good of a job is it doing? And then those three questions will finally answer the last question, which is the actionable question, which is what is most likely to happen from here? What is most probable from here? And once I find out what is most probable from here, my next step is to determine what is the risk for how much do I bet? How much can I bet to find out what probability is going to play out? If I cannot find reasonable risk to do that, then there is no trade, and I will sit. And I'll sit and I'll tweet and I'll do whatever else, but I will not trade. All of these things have to match almost like a pre-flight checklist, okay? So I use whatever I can to determine what edge I can get on the market. But the baseline is volume profile because that's the auction. That's volume and price, period, pure and simple.
Okay. Bob has a question. He says, can you describe initiative and responsive buying and selling, and can you tell people how they can detect that or when it's happening? And I want to piggyback on that. So on a day like today, a very strong trend day, I think this is a good example, a good learning day, right? Because a lot of traders have a lot of difficulty on these really strong moves, as we heard earlier with your risk alarms and such. So using today as an example, maybe you could talk about initiative buying versus responsive buying and selling, and try to help people that tend to get stopped out and try to fade days like today.
Okay. I'm going to start out by saying that if you found the last couple months really, really hard to trade, relax. You're not alone. I know professionals who've been doing this a long time who are just cussing up and down the elevator here at the Chicago Board of Trade building as I go down to grab lunch. It's just the market's in a condition where there's just a lot of money that's been printed, a lot of money that's been sitting on the sidelines, and now that money's being put to work as people perceive that the economy's better. Now back to the question of defining initiative versus responsive. Initiative versus responsive is simply a measure of what the market is doing versus the prior day. So when yesterday's value, so it's the most recent value information we have, is down here. It's between 31.50 all the way down to 27.50. Okay? If the market opens above it, a lot above it, if it gaps up, then I'm looking for responsive selling. Why is it called responsive? Because it's coming back towards, it's responding to higher prices away from value, so I expect it to come back. So in this case, if it gaps up, I'm looking for responsive selling back to value. If it gaps down, I'm looking for responsive buying back into value. However, today coming in, what we had is initiative buying. What that means is it's moving away. It's buying that is moving away from the most recently accepted value. That's what initiative means. It means it's taking the initiative to create imbalance, to go in the direction of balance, imbalance, and it moves away from balance. Okay, those are the kinds of days you do not want to fade, initiative days, because there's a tendency for that to be very strong and aggressive. So that's the difference between initiative and responsive. I think that was the question, right?
Yeah. And the importance of identifying that early on so that you're not trying to fade over and over on a day like today.
Yeah.
Get your butt handed to you.
Yeah, and I spend an awful lot of time, even like if you look at my tweets every morning, that's the goal. The goal for me is to try to find out as early as possible, as many clues as possible as to what the market's temperament is, because it's always easy to see that, oh my God, it's a rally day. Look at that. You could have bought here and sold here, but you only see that once it's done. How do you know that this is done? How do you know that we don't end up at 1700 today? So you don't know that. So what you're doing is you're using the early clues relative to the prior day, and then the early clues relative to the open, things like the opening swing, initial balance, and so forth, to give you some sort of a measuring stick as to what the condition of the market is. You're essentially being a doctor. You're taking blood. Blood pressure can't tell you if you have, some sort of cancer or whatever, but it's an indication that there is something going on if your blood pressure is not normal, within a normal range. It leads you to investigate a little bit more, and it narrows your investigation down. That's what we're doing. We're being researchers and investigators of the market early on. So we use yesterday's value and what it had done before that to determine what is most likely to happen today, and then to try to pick up the clues at the open. What kind of a test did we get at the open? It opened at 1 ticked, and it could not revisit the open. Back off, shorts, back off. And that's why I said caution shorts this morning on Twitter. How do I know? I don't. It's just a response to what it's telling me. I'm just simply reading the market. And that's the biggest issue for most traders, is that they form an opinion and then they defend it. Don't defend your opinion. Just check it against what the market says. The market's always right. Create an opinion and then check it.
One of the things that I've noticed for the last several months is that the initial balance is very often giving us either the high or low on the day. That's usually not the case, but it has been this year. Okay, here's the final question. We're a few minutes over today. Mike is asking if you can elaborate on what kind of information you provide inside of your chat room for the brokerage. Any type of, is there a conversation he wants to know back and forth, or is it pretty much just you talking? How does that work?
Oh, okay. All right, if I can talk about that, I guess. So in the beginning, there's a Twitter button in the chat room. I turned that on, and I put my morning line out there just because I didn't want to abandon the folks that were following me on Twitter from a few years ago. But then I turned that off, and then the conversation continues. It's really a two-way conversation. It's a lot of, like, the chat room constantly is talking about. There are people who constantly talk about their trades. There's a trade convention that we have in there. If you put on a trade, there are some rules. If it's a sim trade, keep it to yourself. If it's a real trade, you need to post it within a certain amount of time from putting it on. I verify those against the risk system to make sure that there isn't any BS going on. And then in addition to that, there's just a constant conversation. I'm in and out all day, but I do see some things. I get asked questions and I respond to them immediately. If not, then people send me private messages. So there's a conversation going on. It's not just me. It's people doing their own research. There are a lot of people who've actually learned to use Excel through the webinars we do twice a week for our clients, who've learned to use Excel and go out and do all these homework assignments, and then they come back and share their homework. So it's really, the chat room's called Traders Helping Traders, and that's really what it is.
Okay, thank you very much, FT, as always, for your time today. Guys, I'll be posting the recording of this session probably about an hour from now on the thread, and we'll see FT back 2 weeks from now on Tuesday the 28th. Thanks, guys.
Thanks for having me on. Take care.
Bye.
Bye.